Hello, I'm Troy Harmon. This is Nick Antonucci. This is your market update from Henssler Financial for the month of February 2018. Nick, let's talk a little bit about what's been going on in the market. Earnings season's in the middle of reporting. This is earnings season for the fourth quarter 2017.
Correct, and we're just about halfway through. We've had about 250 S&P 500 companies report so far. And if you look at earnings growth overall, it looks pretty good. We're up about 17% in earnings, 9% in sales, and that's beat analysts' expectations on the earnings side by about 7%. So we are starting to see some earnings growth that makes us feel a little bit better about the valuations we're seeing in the market, wouldn't you say?
Valuations are still pretty high, but I mean, if you compare that 17%, again, we're just halfway through the fourth quarter, but you have to go back to first quarter 2017 where we were at 15.5% after everyone had reported. So it's an interesting thing to watch. I do prefer to see earnings outpace prices right now because let's talk about valuation. Still a 40% premium according to
historical average.
Yeah, it's historical average according to the price to earnings ratio.
Correct.
Right.
Something else to watch. I mean, while earnings season has been good, it's kind of brought some volatility back into the market, right, Troy?
No doubt.
We started off the year great, up about 7.5% at the peak, and we closed January at up about 5.5%. Where things stand right now, we're looking at, we could be on pace for our worst week in 2 years.
Right.
So we've seen, some earnings reports that have missed, kind of driving sentiment a little bit lower. You've also seen a steepening of the yield curve, which we'll talk about a little bit later, which puts fears into stocks.
Sure.
The long end really shooting up with a 10-year yield, I think around 2.85%.
Right, yeah, and you often expect that. If you see a sell-off in equities, a lot of that money is moving to bonds, especially a treasury, so maybe a little bit of a flight to safety. Hard
Absolutely.
to say. One thing we should talk about, though, Nick, we talk a lot of negative about the valuation, the market, and the sell-off. Economic fundamentals still seem pretty solid.
Yeah, they do. We had our latest jobs report on February 2nd on Friday. 200,000 jobs were added to the economy. That was better than expected.
Yeah,
unemployment
180
rate
was the expectation, right?
Exactly. Unemployment rate hung around 4.1%. Yeah, consumer sentiment come out. It was a beat, I think around 95.1 versus 95 expectations. So a beat, but also relatively in line.
Yeah.
And you had the Atlanta Fed come out this week and say they expect first quarter 2018 GDP to be 5.4%. They don't have the best history of accuracy in predicting this. Nonetheless, it is closely watched.
Yeah.
So
5.4 would be an awesome number.
It would be the highest reading we've gotten since the first quarter coming out of the Great Recession.
Yeah, so we're still really talking about the real numbers we're getting are fourth quarter, right?
Right.
So fourth quarter, 2.6. It was expected right around 3%, maybe a little higher. It was a disappointment when we got that reading. But reality is, the market's still looking forward. It's probably a portion of why we're seeing such high valuations, even down to the consumer sentiment. We got the federal, what are they? The consumer
Conference Board.
Conference Board. I always try to say Consumer Board, but their consumer confidence reading in the last week or so, and it was positive. And the piece that was most positive was expectations, which is kind of a reversal from the previous 3 or 4 months.
That's right.
Let's talk about rising interest rates. January, we had a FOMC meeting, the final meeting where Janet Yellen presided, and we saw no change.
Correct.
We see expectations now. There will not be a February meeting. We'll see one in March. March is expected
99%.
99% to see a rate hike. We'll go from the range 0.25 to 0.5 up to 0.5 to 0.75. If you look further, we see a total of 3 in 2018, with the final one being expected in December. So rising interest rates.
Yeah,
what have we seen the market do since then?
So if you look at the 10-year bond, we're up 56 basis points since the Fed first began tightening with their first rate increase on December 15th of 2015. If you look at the last week, we're up 17 basis points. If you look year to date,
17 of those basis points are just in the last week.
If you look year to date, the 10-year bond is up 42 basis points. So of the 56 that were up since the Fed began tightening, 42 basis points of that has come year to date since the end of 2017.
Yeah, very interesting.
So what you're seeing also, which is different than we've been seeing, we're concerned with the flattening yield curve Now you're seeing a steepening of the yield curve again.
Yeah, but
the
just
spread
in the
between the
last couple
10s
of
and
weeks.
2s
Very
has
short.
widened. Yep.
Right.
And what that does for some, while you've seen stocks fall this week, does that alleviate fears of a yield curve inversion?
Well,
signifying the recession.
Which is definitely a negative signal.
Right.
Yeah. So I think so. It's usually beneficial for banks, not necessarily all financial sector companies, but it's very interesting to watch. And the backdrop that we haven't talked about yet is the fact that the Fed is actually unwinding quantitative easing. Some people are calling that quantitative tightening.
Right.
Where we got this signal back in September of 2017 where the Fed was going to start allowing some of their treasuries and their mortgage-backed securities that they hold on their bloated balance sheet at $4.4 trillion. They were going to start letting that roll off. It's happening.
It is.
We really are just now starting to see some of the effect of that. The treasuries they've actually allowed to reduce. The argument is the mortgage-backs
are actually
not
growing.
so much. Yeah. So January should have been the first true effect. Hey, you know what? The last time we even talked about tapering from quantitative easing, this was not a sell-off or a roll-off. This was just quitting quantitative easing. What did the market do?
Fell.
Yeah, the market fell by about 7 or 8% during that time. So not surprising, given the backdrop, that we're seeing some of the moves in the yield curve and even the
stock
equities market.
Right.
Yeah. So anyway, as we said, valuation's still a bit bloated. Earnings are great. Fundamentals are still pretty solid when we talk about the economy, and that's kind of what we've been watching and what we will continue to watch going forward.
Yep.
Got anything to add?
Go Eagles.
I should have apologized to all of you before we even got started. Nick, as you can see, has his Eagles scarf on. By the time you all see this, I'm sure we'll know the outcome of the big game, but Nick's an Eagles fan, and I'm all about a fan, even if it is an Eagles fan.
That's right.
This has been your market update from Henssler Financial for February 2018. Thank you for watching.